The biggest investing mistake in 2026 may not be avoiding risk. It may be owning the same crowded trade as everyone else and calling that safety. Experts are not broadly saying, get out of stocks. They are saying something stranger. Stop confusing momentum, popularity, and concentration with protection. Right now, inflation has cooled, unemployment remains relatively low, and the Federal Reserve is holding rates steady. But that calmer surface is exactly what makes decisions harder. When inflation eases but does not fully disappear, and rates stay higher for longer, the old easy money playbook breaks, and that is where investing gets complicated. The question in 2026 is no longer just, what can rise fastest? The real question is, what still works if rates do not fall quickly? Across major 2026 outlooks, one message keeps repeating, diversification is back. But not the lazy autopilot diversification investors thought they owned a few years ago. Fidelity argues stocks can still rise in 2026, yet warns that high valuations, policy uncertainty, and concentration risk could punish investors who get complacent. Vanguard sees near-term momentum, but its long-term capital market forecasts suggest future U.S. equity returns may be more subdued than investors have come to expect. Schwab sees a case for international stocks, arguing that cheaper valuations, broader earnings growth, and possible dollar weakness could make non-U.S. markets harder to ignore. J.P. Morgan makes another point. Bonds look more normal again, which means income matters more, and diversification may finally start acting like diversification again. So, the emerging consensus is not sell everything. It is stop building your entire future around one market narrative. And that narrative is about to get tested. Because the one story dominating 2026 is not consumer spending, housing, or even the Fed. It is artificial intelligence, and whether its economics actually justify its hype. BlackRock argues AI capital spending is now so massive that micro is macro. A handful of companies are spending enough to shape growth itself. That sounds bullish, and many strategists still favor U.S. equities. But the hidden risk is not whether AI matters. It is where the eventual profits actually land. If spending is front-loaded, but revenues arrive later, the market can stay excited long before the cash flows become obvious. And that gap is dangerous. And the winners may eventually extend beyond hyperscalers and chip names, even while today's valuations remain packed into a narrow group. That is the first major tension. So, here is the first open loop. Can AI remain the engine of the market without becoming the trap inside the market? Morningstar says the first quarter of 2026 already showed what happens when leadership narrows, confidence stretches, and then sentiment starts to wobble. Through March 23rd, the Morningstar U.S. Market Index had fallen 3.49%, while value stocks and energy held up better than many growth names. Suddenly, just buy the winners looked less like a durable strategy and more like concentrated exposure wearing the costume of common sense. That is why experts keep returning to one unglamorous word, breadth. Not because breadth is exciting, but because narrow leadership can unravel faster than people expect. Many still want exposure to U.S. stocks. They just do not want all that exposure living inside the same handful of giant companies. But even that gets tricky. BlackRock warns that what looks like diversification, such as equal weighting or moving away from dominant themes, can itself become a huge active bet. And here comes the midpoint twist. In 2026, diversification itself may be a disguised market call. That is a much stranger problem than most investors expected. If AI remains dominant, reducing U.S. tech exposure too early can damage returns. But if valuations compress, staying crowded can hurt even more. So experts are not offering certainty. They are building conditional portfolios, structures designed to survive more than one economic outcome at the same time. In plain English, own growth, but pair it with ballast. Chase opportunity, but respect what can go wrong when the narrative changes. And that takes us to the asset class many investors ignored for years, when zero rates made patience feel pointless: bonds. With the Fed's target range at 3.5% to 3.75% and the 10-year Treasury near 4.31%, fixed income competes with stocks again. J.P. Morgan argues that as inflation moderates, bonds can once again provide both income and diversification benefits in balanced portfolios. Schwab's long-term outlook says elevated rates keep supporting fixed income, while equities face a narrowing edge over risk-free investments for investors. That opens the second big question. If bonds finally matter again, which bonds actually deserve a place in the portfolio? Experts do not give one universal answer, but they increasingly favor quality, ladders, flexibility, and a refusal to reach blindly for yield. Fidelity is cautious on long-term bonds, warning that duration risk still matters if inflation re-accelerates or bond yields jump unexpectedly. So, bonds are useful again, but they are not magical. Maturity, credit quality, and inflation sensitivity all matter more than lazy labels suggest. The third theme is geographic. America may stay central to portfolios in 2026, but experts increasingly argue it should not remain alone. Schwab says international stocks could benefit from cheaper valuations, improving global growth, and even a weaker dollar that lifts U.S. investor returns. Morningstar and Vanguard both reinforce a related message. Valuations matter more when liquidity is no longer hiding every mistake investors make. Vanguard's January forecasts estimate roughly 3.9% to 5.9% annualized returns for U.S. equities over the next decade, far below recent memories. That does not mean abandon America. It means stop assuming America automatically deserves to be the entire portfolio every single year. So another expert suggestion is emerging. Keep a U.S. core, but add selective international exposure instead of treating diversification like betrayal. Then comes the least glamorous tool in the 2026 toolkit, cash, or at least enough liquidity to act when markets dislocate. In a market shaped by rate uncertainty, policy shocks, valuation resets, and crowded trades, dry powder is not laziness. It is optionality. The strongest investors this year may not be the boldest forecasters. They may be the people who can buy dislocations instead of merely surviving them. And those dislocations can arrive quickly through bond yields, oil shocks, geopolitical stress, earnings misses, or the first real crack in the AI story. That is why analysts keep emphasizing rebalancing over prediction. They would rather adjust exposure repeatedly than make one heroic forecast and defend it forever. Trim what has run too far. Add where expected return has improved. Rebalance before headlines turn discipline into panic. That sounds simple, but rarely feels easy. Because the real expert playbook for 2026 is almost boring on purpose. And that may be exactly why most people will ignore it. Stay diversified across regions and asset classes. Keep quality exposure to U.S. equities, but respect valuation risk and concentration risk. Use bonds again for income and stability, without pretending every bond behaves the same when inflation, duration, and credit pressures start shifting. Hold some liquidity, stay flexible, and treat diversification as deliberate design, not decoration, not habit, and definitely not a substitute for thinking. The unresolved question is the one investors cannot answer yet. Will 2026 reward the crowd again, or punish it for getting too comfortable? Because if AI spending pays off, concentration may keep winning. But if the payoff spreads more slowly, today's leaders may not carry tomorrow's returns. And that is the real investing challenge of 2026. Not choosing between fear and greed, but building a portfolio that can survive being wrong.